Welcome back to the Value Investors Club. I'm your host, Timo Wunderlich. Let's get right into it with VIC Readings, the format where we look at the best of the best value investment recommendations by the best of the best value investors out there. Today we have KINSALE Capital Group Inc., KNSL. It's a short recommendation, not a recommendation by me though. This is not recommendation in general. This is not advice. Please do your own diligence before investing into anything. And please let me know down in the comments below if you will invest or will not invest into KINSALE Capital Group, or if you will short it, and why that is or why that is not, why you're not doing it. The price at the point of filing is $310. Description summary: we think KINSALE Capital is one of the last remaining bubbles in the post-COVID era. We have invested in a lot of insurance stocks over the years, long and short, but have never seen anything quite like KINSALE. A $7 billion market cap excess and surplus (ENS) insurer trading at a remarkable 12x book value and 40x earnings. The book value multiple is at least twice any historical precedent in the commercial and property and casualty insurance, and roughly 6 times the historical average. We think the ENS insurance cycle is topping out and will likely start turning down next year, leading to a fantastic short opportunity in this highly inflated stock. For some additional background on the company heading into COVID, we would refer you to a January 2020 write-up here by C. Favinger. Situation overview. KINSALE was started in 2009 by some executives from a $900 million market cap insurer called James River. The company went public in 2016 at $16 per share and is up almost 20x since then. We're recently trading at approximately $310, resulting in the highest price to book a multiple of any balance sheet intensive financial company we can recall in our careers. The company underwrites a type of insurance called excess and surplus, which are non-standard risks that most insurance companies want nothing to do with. Think of insuring a gun manufacturer, a SPAC, a cannabis company, or a company with a pattern of harassing employees. Unlike admitted insurance, which is based on standard forms with regulated policies, these are bespoke policies that are unregulated by the states. Within the ENS market, KINSALE has rapidly taken share by often providing the lowest headline premium and quoting business quickly, often within 24 hours, for risks that few other insurers want to take. They price low and put in really strict language that allows them to avoiding paying out on many claims. Facing escalating losses in the aftermath of the financial crisis, standard insurance carriers increasingly shed certain risks, pushing more policies to the unregulated E&S market. This dynamic helped spark a hard bull market that really began to take hold in 2016, perfectly timed with KINSALE's IPO and helping the company generate mid-teens returns on equity on its initial years as a public company. And when COVID hit, insurance companies became very concerned about the potential of spiraling losses, particularly around COVID-driven policy uncertainty, what would be covered by business interruption insurance, etc. This led to significant pricing actions and even stricter underwriting, which pushed more businesses from the standard admitted market into the E&S market. This increased demand turbocharged the E&S market, which experienced massive price increases over the past couple of years. Combined with the worst case fears about COVID related losses not materializing, KINSALE has seen rapid growth with the pricing falling to the bottom line, resulting in current returns on equity well north of 20%. However, we think the COVID driven extreme price increases have run their course and the 6-year-old hard market is about to turn. First, on Chubb's most recent and third quarter earnings call, CEO Evan Greenberg predicted that the standard market would begin to take share back from the highly profitable E&S market. We believe competition and E&S supply is quickly ramping up after years of outsized gains, which demand is likely poised to fail. Wild demand. E&S clients are generally small businesses, and 2023 will likely bring more new business deaths than births at the same as the economy slows. While it's not yet in the numbers, recent calls we did with insurance brokers highlighted what appears to be a changing market. Here's some select quotes. I think we are fast approaching a soft market. I'd say late July, early August first saw some market softening. Could we be in a full fledged soft market a year from now? 100% yes. As the market softens and more brand name insurers begin to go after KINSALE's clients, we think KINSALE will start to feel a significant impact, likely driving a return on equity back to mid teens levels, if not ultimately lower. As one broker told us, no one wakes up and says, I need a KINSALE policy. If I'm quoting KINSALE, I've surveyed everyone else. They are the last resort. After taking out a KINSALE policy, one client even told his broker, the minute you can pull KINSALE for a new insurer, pull it. What we think it's worth. We generously see KINSALE fair value at around $100 in just over 1 year, down roughly 67% from current prices, which corresponds to a still pricey 3x book and 16x of our 2024 earnings. This assumes the company would generate an 18% return on equity above what we believe is a more normalized target range of 40% to 15%. If the cycle really turns hard as industry capacity overwhelms cooling demand, profitability and the stock could head considerably lower. Catalyst: weakening E&S market conditions resulting in slower growth and lower profitability. Thank you very much for tuning in. See you next time. Please write down in the comment below what you think of KINSALE and of the short idea. I personally will not do it because I don't short. Because who said that? You can a stock can remain asymmetric for a longer time than you can remain solvent. And shorts, the losses are unlimited. So that's why I will not short anything for now, and especially not an insurer because I don't know enough about that business. That's my take, but please tell me if you do short and why you will short or